Welcome to our College Savings Showdown, where we compare 529 plans and taxable brokerage accounts to help high net worth families decide how to fund education most efficiently. First, we will set the stage with an agenda. Then we will add a brief but important disclaimer, and afterward we will analyze both options, highlight flexibility, and end with a hybrid strategy you can tailor to your goals. Here is our roadmap. First, why this decision matters for high net worth families. Next, the 529 plan advantages and how flexibility actually works. Then, we will examine the control and trade-offs of a taxable brokerage account. After that, we will compare them side by side, walk through example numbers, and propose a practical hybrid strategy. Finally, we will quiz your understanding, summarize the key takeaways, and wrap up. Before we dive in, a quick but important disclaimer. This video is for educational purposes only and is not tax, legal, or investment advice. Rules vary by state and may change. Consult a qualified tax professional or financial planner and verify your state's 529 plan rules, including contribution limits, potential deductions or credits, recapture provisions, and rollover policies, before making decisions. Now to the big picture. High net worth families typically have sufficient flexibility, but maximizing tax efficiency can drive meaningful improvements in after-tax outcomes. Meanwhile, the earnings premium associated with post-secondary education continues to widen, making thoughtful college funding more important. Therefore, selecting the right account type can significantly influence how much your dollars ultimately cover. Let us begin with the 529 plan's tax shield. First, many states offer a deduction or credit for contributions, which immediately reduces state income tax for residents using their in-state plan. Next, the major advantage is tax-free growth and tax-free withdrawals when used for qualified education expenses such as tuition, fees, books, room and board within limits, and required equipment. For high earners subject to elevated capital gains and potential net investment income tax, avoiding tax on decades of compounding is tremendously valuable. Additionally, the curated investment menus and age-based options can help hands-off investors avoid market timing mistakes. Finally, certain expanded uses exist, including up to $10,000 per year for K-12 tuition in many states, a limited allowance for student loan repayment, and the ability to change the beneficiary within the family. Next, let us address flexibility. You can change the 529 beneficiary within the family, including siblings or even future grandchildren. Additionally, many states allow up to $10,000 per year for K-12 tuition. Under recent rules, subject to conditions like the account being open for 15 years and contribution timing, up to $35,000 can be rolled over to the beneficiary's Roth IRA over their lifetime, within annual Roth IRA contribution limits. If you do take a non-qualified withdrawal, only the earnings portion is subject to ordinary income tax and a 10% penalty. Your contributed principal is always returned tax-free. However, be aware that some states may claw back prior deductions or credits if you later make a non-qualified distribution. Here is a decision flow. First, you contribute to the 529 and invest. Next, if the withdrawal is for qualified education expenses, the path leads to tax-free withdrawals. However, if the expense is not qualified, the earnings portion becomes subject to ordinary income tax plus a 10% penalty, while principal is returned tax-free. Meanwhile, there are options to change the beneficiary within family, to use up to $10,000 per year for K-12 tuition where allowed, and to roll over up to $35,000 over a lifetime to the beneficiary's Roth IRA, subject to the 15-year account rule and annual IRA limits. Finally, note that some states may recapture earlier deductions or credits when distributions are non-qualified. Now let us consider the taxable brokerage account. First, it offers maximum liquidity. Funds can be used for college, a business, or emergencies without penalties. Next, you have unlimited investment choices, including individual securities and strategies. However, dividends are taxable annually, and capital gains are taxable when realized, which reduces compounding compared with a tax-advantaged account. Custodial accounts such as UTMA or UGMA may be used to earmark assets for a child, but the kiddie tax can apply to unearned income, and control typically shifts to the child at the age of majority. Consequently, a taxable account often serves well as a supplemental reserve to a 529 for non-education or timing-sensitive expenses. Here is the side-by-side comparison. On the left, the 529 plan offers tax-free growth for qualified education spending, possible state tax benefits, and menus that can help prevent timing mistakes. It is flexible through beneficiary changes and limited K-12 and student loan uses, and it is usually treated as a parent asset in financial aid formulas, which is more favorable than student assets. On the right, a taxable brokerage account provides complete liquidity and unlimited investment choices, but dividends and capital gains are taxed, reducing compounding. UTMA or UGMA accounts can trigger kiddie tax and transfer control to the child at the age of majority. Student-owned assets often weigh more heavily in aid calculations. Let us quantify the impact with a simple illustration. Assume a $100,000 lump sum invested at 6% annually for 18 years, yielding approximately $285,000. In a 529 used for qualified expenses, taxes are zero, so the full balance is available. In a taxable account, if you buy and hold and realize gains upon liquidation, the gain is roughly $185,000. At 23.8% federal long-term capital gains and net investment income tax, the tax is about $44,000, leaving approximately $241,000. At a combined 28.8% with state taxes, the tax is about $53,000, leaving approximately $232,000. This ignores dividends, state deductions on contributions, fee differences, trading, and exact timing. It is for illustration only. Actual results will vary. Next, here is a practical hybrid approach. First, estimate core education costs you intend to cover, and pre-fund those through a 529. Second, either front-load using the 5-year gift tax election if appropriate, or contribute regularly to capture compounding. Third, select low-cost age-based or index options to minimize fees and behavioral risk. Fourth, maintain a taxable brokerage account as a flexible reserve for non-education needs, early cash needs, or opportunities. Fifth, coordinate timing of 529 and taxable withdrawals to manage taxes and to preserve favorable financial aid treatment. Finally, review annually to adjust contributions, beneficiaries, and the investment glide path as circumstances change. Now consider a simple timeline. In the first year, open the 529 and choose low-cost options. From years 1 through 10, automate contributions and invest consistently. From years 10 to 18, gradually shift toward a more conservative mix to reduce volatility risk as expenses approach. During the college years, pay qualified expenses from the 529 and use the brokerage account for non-qualified or timing-sensitive needs. After college, if the rules in your situation allow, consider a Roth IRA rollover of remaining 529 funds within limits. Before the quiz, here are concise rules of thumb. First, target core expected expenses with a 529 and keep discretionary or uncertain costs in taxable. Second, prefer low-cost index funds to reduce drag. Third, if your state offers a deduction or credit, capture it before considering out-of-state plans. Fourth, for larger gifts, evaluate the 5-year election to superfund a 529. Fifth, remember that only earnings are taxed and penalized on non-qualified withdrawals. Your basis is return tax-free. Quiz time. Which benefit is unique to a 529 plan compared with a taxable brokerage account? Option A, tax-free growth and withdrawals for qualified education expenses. Option B, unlimited investment choices. Option C, no penalties regardless of use. Or Option D, guaranteed investment returns. You may pause the video now to think about the answer. Will you or Faye? We will discuss the answer in the next section of the video. The correct answer is tax-free growth and withdrawals for qualified education expenses. Unlimited investment choices are a hallmark of taxable accounts, not 529s. There are penalties for non-qualified 529 withdrawals on earnings, and no investment vehicle can guarantee returns. Second quiz. What typically happens with a non-qualified 529 withdrawal? Option A, only the earnings are taxed as ordinary income and face a 10% penalty. Option B, the entire withdrawal incurs a 10% penalty. Option C, you pay only capital gains tax as in a brokerage account. Or Option D, there is no tax if the amount is under $35,000. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that only the earnings portion is taxed as ordinary income and subject to a 10% penalty. Your contributions are returned tax-free. Certain exceptions, such as scholarships up to the scholarship amount, may waive the penalty, but income tax on earnings still applies. Rules can vary by state, so confirm details. Here are the key takeaways. First, tax-free 529 compounding can materially outperform taxable accounts for education goals. Second, flexibility is better than many assume due to beneficiary changes, certain K-12 uses, and, in limited cases, Roth IRA rollovers. Third, taxable brokerage accounts excel at liquidity and unlimited choice. Fourth, for many high net worth families, a hybrid approach using a 529 for core costs and a taxable account for flexibility is optimal. Finally, always confirm state-specific rules, costs, and your tax situation. In summary, the 529 plan is a powerful tax shield for education, while the taxable brokerage account offers freedom at the cost of tax drag. Quantitatively, taxes on gains can materially reduce net funds in taxable accounts. A blended approach often serves best. Pre-fund essential education costs with a 529 and maintain a liquid brokerage buffer for everything else. Review annually and coordinate with your advisor. Before we close, one more reminder. Rules continue to evolve. Provisions from the Secure Act and later updates require careful reading, and state conformity can differ. Some states may recapture prior tax benefits on non-qualified withdrawals. Confirm specifics with your state plan and professional advisors before acting. Thank you for watching. If you found this helpful, please like, share, and subscribe. Tell us in the comments whether you prefer a 529, a brokerage account, or a hybrid approach and why. We appreciate your feedback and ideas for future videos.